So now let's calculate, or let's talk about the concept of a beta. We've seen this earlier in corporate finance. So the most important beta is the sensitivity of returns. This is the sensitivity of the return over the risk-free rate to the market risk premium, which is the return on the market minus the risk-free rate. So there are two ways of looking at beta. One is through a calculation, and the other is estimating using historical data. So let's first understand the calculation for beta. So the beta for a given stock I is going to be equal to the correlation between stock I and the market multiplied by the standard deviation of stock I divided by the standard deviation of the market. So this is very important. Logically, beta gives us an indication of how a given stock moves with the market. If you take the beta of the market itself, then what do we have? So the beta of the market itself is going to be the correlation of the market with itself multiplied by the standard deviation of the market divided by the standard deviation of the market. Notice that all these terms are 1. Correlation of the market with itself is 1, and obviously sigma m over sigma m is 1. So the beta of a market, you will notice, is always equal to 1. If a beta of a stock is equal to 2, what this essentially means is that the stock has relatively high systematic risk, and if the market is going up by 2%, that means that stock I is expected to go up by 4%. If the market goes down by 2%, the stock is expected to go down by 2%. Now, how can we estimate this using past data? We use a technique called regression, where over several past periods we can look at the return on the market versus the return of a given stock. And if we look at several periods and plot data that looks something like this, we then try to find a line that best fits this data, and the slope of this line shows us the sensitivity of the returns of stock I to different market returns, and this slope is the beta. So again, as long as you just understand this basic point, that's good enough. So essentially we've seen two ways of coming up with beta. One is this calculation where you need to know the formula, and the second is this method which is called regression, and this is basically an estimation based on historical data. Okay, now let's talk about one of the most important items in finance, which is the capital asset pricing model, or CAPM, and we will begin by looking at the assumptions behind CAPM, and you need to memorize these 6 assumptions. So number 1 is that investors are risk averse, which means that to take on risk they need to get a higher return. They are utility maximizing, so they want to be as happy as possible, and investors are rational. The second point is that we have frictionless markets, which means no transaction costs, no taxes, and so on. The third is we assume a single holding period, so all investors assume a single holding period for their investments. Number 4 is homogeneous expectations. So the return expectations about all stocks is the same. The correlations, covariances, etc. between various investments is the same. So that's homogeneous expectations. Number 5 is that investments are infinitely divisible, which means that investors can buy half a share, 3/4 of a share, and so on and so forth. And finally, investors are price takers. So whatever price is given in the market, investors simply take that price. So obviously these assumptions look a little stiff, but as with many things in finance, we come up with models based on assumptions, and that gives us some insights. We can then relax each one of these assumptions and see what happens, but from an exam perspective, simply memorize these 6 assumptions. So now let's talk about the security market line, which is simply a graphical depiction of the capital asset pricing model. You've seen the capital asset pricing model earlier in corporate finance, so we will come up with the equation again, show it over here, and also talk about the concept of security selection using the SML. So in essence, with the security market line, what we are saying is the following. Actually, let's first come up with the equation for CAPM, which you must know. So the equation for CAPM is that the return on a given stock is equal to the risk-free rate plus the beta for that stock times the market risk premium, which is the expected return on the market minus the risk-free rate. So this is your capital asset pricing model, which you need to know very well. When we plot this out as a security market line, the y-axis is the return on a given stock, and the x-axis is the riskiness, which is depicted by the systematic risk. So notice here that CAPM is based on systematic risk. So an investor gets higher return for taking on more systematic risk. The investor is not being compensated for non-systematic or diversifiable risk. So this point is the risk-free rate, and the slope of this line, so the slope of this line is simply the market risk premium. So the slope is equal to the return on market minus the risk-free rate. This is also called the market risk premium. And essentially what the SML is telling us, that for a given level of risk, let's say that this represents beta equal to 1, which is the market risk. So for a given level of risk, what is the return that we require? So if the market risk is 1, so if the riskiness is given by beta equal to 1, then we require the market rate of return. If the riskiness is say 1.5, then we will require a return that is above the market rate. So how do we identify mispriced securities? Let's say that security A shows up over here, which is saying that security A has a beta of 1.5, but we are expecting a return of, let's say, 19% on A. So we are expecting a return of 19%, but let's say that this point over here, which is on the security market line, is at say 18%. Securities that plot above the security market line are undervalued. That means that we are expecting a higher return than what is required for that level of risk. So any securities that you find above the security market line are a buy. So sometimes you can say they are a buy. So you can also say they are underpriced, or you can say that the return that you are expecting on them is more than what you require given the level of risk. Securities such as B, which plots under the security market line, is overpriced. This is because the return that you are expecting on B is below the return that you require for this level of risk. So very important points. Make sure you understand this concept well, and that you can identify securities above the SML as underpriced and below the SML as overpriced. Let's now talk about a few applications of the capital asset pricing model. One of the most important applications that you saw in corporate finances, we use this model to estimate expected return. If you recall, in our weighted average cost of capital formula, one of the inputs was the required return on equity, and to calculate the required return on equity, we actually used the CAPM formula. So this required return is actually a first level approximation for the return that we expect on a given investment. And then once we calculate this, this is also used in valuation, as you will see later in the segment on equity. But for now, that's what you need to know here. Now in the curriculum, there's also a lot of discussion on 4 performance evaluation ratios: the Sharpe ratio, Treynor ratio, and 2 more that you will see on the next slide. So let's talk about each one of these ratios. You've seen the Sharpe ratio before in quantitative methods, and this is extremely important, so we are going to see it again. The formula for the Sharpe ratio is the return on a portfolio minus the risk-free rate divided by the standard deviation of the portfolio. So this is using the concept of risk and return. So it is telling us how much return a given portfolio is generating above the risk-free rate divided by the riskiness or standard deviation of the portfolio. So when we compare portfolios, we want to go with the portfolio with the highest Sharpe ratio. Okay, so what is good and bad about this ratio? The good thing is that it's easy to calculate, it's intuitive, but the negatives are that we are using the total risk, which includes the non-systematic or diversifiable risk, and we do not use the beta. So that is going to be addressed in the next one. So issue number 1 is use of total risk. Another issue here is that we are simply coming up with a ratio, and this has to be compared with other ratios to see which portfolio is better. And then even when you compare, say one portfolio gives us a ratio of 0.7, another gives us a ratio of 0.8. Clearly this one is better, but 0.1 difference doesn't tell us how much better. So those are the few issues with Sharpe ratio. Now the Treynor ratio is a little better. The formula for this, which you must know, is the return on a portfolio minus the risk-free rate divided by the beta of the portfolio. So this is a slight improvement on the Sharpe ratio because we are using the concept of systematic risk and not the total risk. So in that sense, Treynor ratio is better, but the other limitation still holds, that this is a ratio, and while it tells us which portfolio is better, it does not tell us how much better. So these are the most important points that you need to know. Make sure that you do example 10 in the curriculum that shows different portfolios, makes you calculate these ratios and talks about them. So that's, this is excellent practice. Now let's go over 2 more ratios which might seem a little complicated. I don't want you to get hung up over them, just understand what the formula is and how to interpret the formula. So the M squared ratio is equal to the return on a portfolio minus the risk-free rate multiplied by the standard deviation of the market divided by standard deviation of the portfolio minus the market risk premium, which is RM minus the risk-free rate. So this in a way is an extension of the Sharpe ratio, because we are still using the concept of total risk. So in that sense, it is sort of analogous to the Sharpe ratio, and the results that this will give, if we are comparing portfolios, the results that it will give are exactly the same as the results that we will get from the Sharpe ratio. The difference now is that for a given portfolio, we actually are looking at a risk-adjusted comparison relative to the market risk premium. So we don't have to. So when this ratio is more than 0, that means that this portfolio is better than the market. So we don't necessarily need a comparison the way we needed with the Sharpe ratio, but the limitation still holds that we are using total risk. Now with Jensen's alpha, the formula is as follows. So alpha for a portfolio is equal to the return on the portfolio minus, and after this essentially comes the CAPM formula, which is the risk-free rate plus beta of the portfolio times RM minus the risk-free rate. So this is effectively your CAPM formula. Now from a theoretical perspective, this is the best because this is giving us the return on a portfolio. So alpha P is the Jensen's alpha, RP is the return on a portfolio, minus this is the risk adjusted return on the portfolio. So this is saying that for a given portfolio, what is the return that we would expect given the level of systematic risk. So since we are using systematic risk, this is an extension of the Treynor ratio. So it is good that we are using systematic risk. So this part that I have put in parentheses, so this part represents the risk that we expect or require given the, so this gives us the return that we require given the level of systematic risk. And if the Jensen's alpha is positive, that is saying that our portfolio is returning above what we require. So the higher this Jensen's alpha, the better. Why do we do all this? The core point about coming up with these ratios is that if you have an investment manager who is charging you a fee for picking stocks and making your portfolio, you want to determine whether the fee that he is charging is really worth it or not. And these two ratios are a great way of doing that, and ideally this would be theoretically the best. So if your portfolio manager is actually giving you a return that is above the risk adjusted rate, then it is worth paying him for it. If not, then you are better off simply investing in the market. Again, I will repeat that to really internalize these concepts, go ahead and do example 10 in the curriculum, and when you do the problems at the back of the book, it will also become, this whole concept will become quite clear.